Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back, kick up your feet, because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Good afternoon, everyone, and welcome to Coasting in Retirement. I'm your host, Josh Knoll, and I'm joined by my co-host, Michelle Lee Melton. Michelle, how you doing?
I'm doing fine. I was just griping about the weather, though. It's so March weather with this coldness and raininess.
Yet it's April, so everything's a little behind.
Global warming should be working out for us down here.
Right. Well, it's great to be back in studio with you. We're taking a quick break from our Jubilee Studios in Daphne. This time we're recording our episode in Coastal College's podcast studio.
Yay, college.
Right, which is located here in downtown Fairhope, and it's actually right across the street from my Gulf Coast Financial Advisor's office, which is kind of cool, right?
Yes.
Okay. Well, hey, folks, Michelle and I are here today to discuss financial topics relevant to those in or near retirement, living their best life here along our part of the Gulf Coast. If you're just tuning in, I can promise you that you'll want to stay tuned in. We've got a great show for you today. We're going to kick off the show with a discussion about our main topic, which I'll get to in a minute. Then stay tuned. About 15 minutes in, we'll dive into recent headlines with our Michelle with the News of the Week segment.
Woohoo!
Yep. And then about 30 minutes in, or 30 past the hour, if you're listening to this on the radio, we'll get to poke a little fun at me with our Where Josh Nailed It, Where Josh Was a Little Off segment. And then finally, if we have time, we'll finish up with our Living the Gulf Coast Life segment, where Michelle and I get to talk about all the cool stuff we get to do down here living in lower Alabama, although being out on a boat this week and this weekend is probably not part of that equation, right?
Sadly, no.
Right.
I mean, but you never can tell.
You never can tell. Well, for those of you new to the show, quick background on me. Again, my name is Josh Knoll. I'm a fee-based fiduciary financial advisor. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. That is an independent investment management and financial planning firm based out of downtown Fairhope, Alabama. You can find more information on me and Gulf Coast Financial Advisors by visiting our website, gulfcoastfa.com, or you can always give us a call at 251-327-2124. If you didn't catch that, don't worry. We'll repeat our contact info throughout the show. All right, so let's get to our main topic. I'm going to start it this way. Michelle, let me ask you a question. Recently, have you, or past several months, have you or anyone you know been a little more nervous than usual about their money?
Of course.
Okay. All right.
For me, that's standard since day one.
That's standard since day one. But have you noticed a little more tenor in the air?
Yes.
Yes, I have too.
And banks are failing.
Right. Yeah.
And nobody seems to be doing anything about it.
Well, we did. We did an episode on it.
We did.
Help people explain it. Well,
but we're not in charge.
Yeah, fair. That's right. So here's the thing. It's been a little unsettling out there, but fortunately, just like with explaining the bank failures, Michelle and I are here to help. Today, we are going to lay out 4 simple steps for those of you all that are nervous about your money, steps to take, especially, again, the show is geared towards those in or near retirement, or these are probably steps for any investor of any age. So let me repeat that. For those of you feeling a little uneasy regarding your retirement savings and investments, we've got a couple of solutions to consider. Got it? Good. All right, so in no particular order, let's lay out our 4 simple steps, and then we'll explain in greater detail throughout this first segment. Step number 1, no particular order. If you don't have a financial advisor, consider using one, but only after you interview them first. Advisors come in many flavors. Some are investment management focused, some do financial planning, some are brokers, some are insurance agents, some are a mix of all the above. We're going to give you the tips on how to decide, one, how to figure out what kind of advisor they are, and also tips on how to decide what type of advisor to go with. Number 2, consider getting a comprehensive financial plan and possibly forming an estate plan if appropriate. This is one of those things, if you haven't started taking, particularly for those of you all that have not started taking Social Security yet, it's good to have a financial plan because that can help you optimize the timing of that decision. We'll talk more in detail here in a minute. Number 3, get an analysis performed on your existing investment portfolio. We're going to talk more about the tools we use to help folks do kind of an MRI, X-ray type of thing of the portfolio. Tools such as Riskalyze, which we use to see if your investments are truly matched up to your goals and your time horizon. And tools like Retire Up, which we use to look at retirement income solutions. We'll touch base more on that here in a minute. And then number 4, get basic tax planning services, not tax preparation, tax planning. Now, tax preparation would be the job of your accountant or your CPA, which I am neither. What I'm referring to is forward-looking tax planning, particularly if you are going to be using the sale of a business or a property to fund, or at least partially fund, your retirement. Again, one of the tools that we have, we like to talk about the tools we use because it's cool and I'm a nerd. One of the tools we have available to us is a software program called Holistoplan. We use it to do a deeper dive into your tax returns and to make sure you are keeping as much of your hard-earned dollars in your pocket as legally possible. Again,
that sounds very metaphysical.
I like that, right?
Mm-hmm.
Well, as with everything else, we'll touch more about these here in just a minute. All right, so Michelle, let's start with number one. Again, folks, these are no particular order, but number one was, if you don't have a financial advisor, consider using one, but only after you interview them first. Michelle and I are going to give you some tips and some questions and some things to look for when you're looking at financial advisors. Even if you're coming in to talk to me, I'm happy to answer these questions. I'll probably answer a bunch of them in this episode anyway. But if you don't have a financial advisor, it's one of those things where I understand why people can be hesitant to utilize financial advisors, both because money is very personal. Also because I think it's fair to say that sometimes in our industry, the financial advisors, we've been given a little bit of a black eye for some of the things that we've done. One would argue in some respects that a person can get just as far on their own. And if you're talking about just raw accumulation over the years, like in a 401k with, say target date funds, you're probably right. Really for this, especially for the focus of this show, getting a financial advisor when you're in or near retirement, there's so many other factors at play that need to be accounted for. It's not, the old adage in my industry is, climbing up the mountain, great, you did it, you hit the peak, now you're about to retire. Well, how do you get back down, without just falling down the mountain and getting in real bad shape? And what that means is, particularly with drawdown risk and something called sequence or return risk, which we're going to talk about later in the show, also with income planning and tax planning, there's a lot of things that go into making sure that you don't outlive your money. And a good financial advisor, which is one you can really drill down with the right questions to ask and looking at their background and their experience and their areas of expertise, is going to be something that hopefully will enhance your financial plan and really make it hit the goals that you're trying to hit. And I'm telling you, just having done this so many years, there's been maybe, I can count on one hand, the folks that have been able to do this on their own. And these are people that lived, breathed, and ate their own financial plan. I mean, they were all in, almost like they had a second job. The rest of it, it's really good. It's kind of like getting an attorney or getting a CPA. Yes, you can do your own taxes. Yes, you can handle maybe some of your own basic legal matters. But if you've done a good job of accumulation and now you've got, you're looking at 20, 30, 40 plus years in retirement, get some help. You'll be glad you did, and get the right help. All right, so number two was consider getting a comprehensive financial plan and possibly forming an estate plan if appropriate. This kind of goes hand in hand with, talking to a financial advisor, because in my opinion, and again, we'll talk about this more later in the show, a good financial advisor is also going to be able to give you a financial plan or be a financial planner. And it kind of ties into what we just said. If you've got a roadmap, getting to your destination, getting to the top of the mountain, those are great. I mean, you should applaud yourself if you've gotten yourself to a position, say 5 years or less, maybe even a couple years or less, where you're ready to retire and you're feeling pretty good about it. But if you want to feel great about it and you want to take some of the emotion out of your money, particularly when you're retiring, possibly retiring into a very volatile stock market, which is what we've had the last couple of years. If you want to take some of that ease off, or put some ease into that, take some of the worry off the table, then look at getting a comprehensive financial plan. It's not, generally speaking, it's probably not as expensive as you think. Generally speaking, it's probably not as complicated or as invasive or any of these things. Technology has really allowed people like me to be very efficient with our time and forming these comprehensive financial plans. Plus, with all of the ability to update information, in real time, you have a financial plan that changes and adapts with your life. Because even if let's say you retire at 65, more likely than not, your life is going to be very different at age 80 or 85. Maybe even if you live to be 100 plus, right? Your needs are going to change. Your plan needs to change with it. And we've got the ability to do that with a comprehensive financial plan. That's one of our really key focuses we have at Gulf Coast Financial Advisors. All right, let's talk about number 3. Oh, one more thing on getting a comprehensive financial plan. If you forget everything else I say in this segment, for those of you that have not taken Social Security yet, have not triggered it, which 62 years old is the earliest you can, and let's say you're 60, or maybe you're 62, 63, 64, and you've delayed it because you haven't needed the money yet. If you take nothing else away from this show, I think it's really important, if you have not started taking your Social Security yet, to talk to somebody about putting together a financial plan, because that can absolutely help you optimize the timing of that decision. And for a lot of people, that is a really, really key decision for income planning and retirement for Social Security. So anyway, last point on that. All right, moving to number 3, again, no particular order. Get an analysis performed on your existing investment portfolio. So what does that mean? There are tools. You can do this manually. A good financial advisor with investment management experience, somebody, especially somebody that's picked their own basket of investments before, they can go through. They're going to recognize things that make sense for your situation. They're going to recognize things that maybe look a little, like, okay, why'd you do this? Why do you have a non-publicly traded REIT when you need liquidity on this other part of your portfolio, so on and so forth, right? But there's all, just like with the financial planning, with tools like eMoney, there's been software programs come along relatively recently that has allowed advisors like myself to do an MRI, or really in-depth X-ray at the very least of your investment portfolio. Tools like Riskalyze, and what Riskalyze is going to do, it's going to see, do your investments, one, what is the actual risk score of your investments? If you're a conservative person and you get in there and you've got a high risk score on your investment portfolio, well, you don't match up. 2, it's going to look at what are the fees in your investments. You may be in things that are expensive that you don't necessarily need to be in. And it's I'm telling you, having done this manually in the past, it's hard to really drill down and find all of the nooks and crannies of the fees in various investments, particularly if you're in a loaded, actively managed mutual fund. There's money flying out of your account all the time. So tools like Riskalyze really help us go in, almost like a doctor having the ability to have the MRI machine right there. And now we can really see what's going on inside that investment portfolio. Another tool we use that is for retirement income solutions, also plays into the retirement planning part of this. The financial planning is a tool called Retire Up. And that's really going to be, a lot of it is math, but it's really diving in deep, using algorithms combined with the common sense and the experience of the financial advisor using the tool to look at, okay, again, the number one thing for most people anyway, most retirees, how do I not outlive my money? Right? So these are things that we can definitely put together for you. If you're interested in that, particularly the Riskalyze exercise, happy to do that free of charge. Just give us a call, 251-327-2124. I'm such a nerd that I actually like using that tool. So, all right, and then number 4, and if you're just joining us, these are, if you're a little nervous about your money, your investments, these are 4 steps to hopefully help ease your mind. Number 4 was get basic tax planning services. So not tax preparation, that would be the job of your accountant or your CPA. I'm neither. What I'm referring to is forward-looking tax planning. Again, particularly for you all that are using the sale of a business or businesses or some property to fund your retirement. You're going to be walking into probably a fairly unique and one-time tax event in your career and your life. And if you don't get the proper look at what you're doing, sometimes you're talking about hundreds of thousands of dollars left on the table that didn't need to be. You always want to pay your fair share. You always want to pay what is due to the IRS, but you don't want to pay a penny more. And one of the things that we can do, again, going back to all these software tools that we have available, we can use a software program called Holistoplan. It's going to allow us to take a deeper dive into your tax returns, make sure you're keeping as much of your hard-earned dollars in your pocket as legally possible, but as important or more important, it's going to allow us to look forward. It's going to allow us to take into account the sale of the business or the retirement, or possibly looking at doing a backdoor Roth or sale of property, all these things that are going to be unique to your situation that really it's important, I think, that you make sure that you are really sticking the landing on how your tax liability and exposure. And we do that in hand, just so any CPAs or accountants that are listening to this. My partner, Will Stye, is a CPA by training. He does not do tax returns. He does tax planning along with the financial advising and investment management that we do at Gulf Coast Financial Advisors. And I feel like between Will and I, we do a great job of working with our CPA partners to help everybody get both the best way looking backwards, which is the CPA's job, and the best way looking forward, which is our job for the most part. And I think we do a great job. All right, folks, that was the top 4 ways to maybe ease your mind if you're a little bit nervous about your money. Coming up next, there's always a lot going on in the world, particularly the world of finance. And as always, this past week was certainly an example of big news in finance. So every week, Michelle and I scour what she calls the interwebs for helpful financial articles related to our topic of the day, especially articles that pertain to those in or near retirement. So I want you all to join us after the break to hear Michelle and I discuss this week's relevant headlines in our Michelle with the News of the Week segment. Stay tuned.
Hi, I'm Michelle from Coasting in Retirement, a show that you might have heard on Sundays at noon. If you're looking to inflation-proof your retirement and are ready to take that next step, but don't want to wait for one of those upcoming seminars, just give the advisors at Gulf Coast a call today and schedule your no-obligation sit-down with Josh and his team. Maybe it's time for that second opinion after all. Call 251-333-5151 or visit us on the web at gulfcoastfa.com. And make sure to listen on Sundays at noon right here on the Talk 106.5.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. PCIA 6201, College Boulevard, Suite 150, Overland Park, Kansas 66211. PCIA doing business as Prime Capital Wealth Management and Qualified Plan Advisors. PCIA and Gulf Coast Financial Advisors are not affiliated.
Welcome back to Coasting in Retirement. Your host, Josh Knoll here. So as we discussed before the break, every week Michelle and I scour what she calls the interwebs for helpful financial articles related to our topic of the day, especially articles that pertain to those in or near retirement. Michelle and I are then going to help you all understand and decipher the deeper meaning of these headlines, or hopefully at the very least we'll provide some context. So without further ado, here is Michelle with the news of the week.
All right, Josh, I'm going to start us off with an article related to your suggestion that folks consider using a financial advisor, but definitely interview said advisor first. The headline comes from CNN Business. Quote, 4 things to ask for before you hire a financial advisor. This article talks about the different kinds of financial advisors, including how they get paid and the type of work they do, and how investors should be pretty blunt when asking certain questions. Which I like them pointing that out because the potential financial advisor is going to be asking some pretty pointed questions.
Fair, right?
Right?
Yeah, it gets pretty intimate pretty
So
quick.
when someone is looking for a financial advisor, what do you think is the most important in their search? And do you think investors should be as bold with their questions as this article suggests?
So, all right, so first to answer your question, yes, I think investors should absolutely be bold with their questions. You don't necessarily want to be rude, because sometimes people in my industry can get kind of lumped together in a certain fashion, but definitely be bold. The problem with my industry is that, not the problem, but one of the things that's confusing about my industry is that people get to use the term advisor in a really broad array of different ways of going about doing investment and financial planning and advising.
Apparently not in Canada.
Not in Canada. Canada's a little different. Mm-hmm. And what happens is the regular everyday investor probably doesn't know how to tell one of us apart from the other. So let's do this real quick, Michelle. So here are some basic type of quote-unquote advisors. There's fee-only / fee-based. There's duly registered agents. There's brokers. There's insurance agents. So
Snake oil.
Well,
salesman.
now come on, easy. Now you sound like you're being too blunt. But so fee-based, fee-only advisors, that would be fee-for-service. Those are the ones. That's kind of where the industry is going, where they charge a lot of times what is called an asset under management fee. Call it 1% on whatever investments that they manage for you. You can see what that fee is. Typically, it's the most transparent way of managing investments, but it's not necessarily for everybody, and we're going to talk a little bit about that. Duly registered agents it's one of those things that's kind of starting to slip away a little bit. That would be an agent or advisor that could do the fee for service, but it could also sell you like Class A mutual funds or variable annuities. They're still out there. There's still the brokerage houses of the world, but you don't see it as much. Brokers, that would be kind of along the lines of when you all years ago watched Wall Street. Guys selling stocks or selling mutual funds with a commission on it. staring at 3 computer screens all day typically, not always, but typically. And of course, insurance agents, which are more often not going to steer you towards some type of insurance product or an annuity product or anything like that, which we talk about on our previous episodes if you want more in depth on that. Here's really the most important thing. Most people are going to make, or a lot of the media, if you will make a big deal about how the advisors are paid. And there is some importance to that, especially when a lot of stuff is front loaded. But really what matters is if the advisor is being incentivized to perform the task you need. For example, are you a buy and hold investor? Say like a Dave Ramsey system, that buys American funds and holds them for 20, 30 years. Then maybe a commission-based broker is fine. Really what though has happened is the industry has migrated to the fee-for-service model. That is what we are. We are fee-for-service. We're fee-based. And if you listeners or if any of y'all are interested in learning more about what that means and how that compares and contrasts to what you have currently or maybe what you're looking at, just give us a call at 251-327-2124. Great headline, Michelle. What do you got next?
Okay. Next, we're going to pivot to our good buddy, Chuck Schwab. So Chuck has a recent article titled 5 Ways Financial Planning Can Help. So I like that. He gets it.
Yeah,
5.
4.
Yeah.
Right.
Yeah.
I did 4 on this episode just to aggravate you.
Yeah, and I said something in between. So, okay. So secondly, the article states that only 1/3 of Americans have a written financial plan. And in a survey of those that didn't, the 3 primary reasons were all related to folks thinking they didn't have enough money to make a plan, or enough time, or just too complicated. It's also depressing and or scary. Those are my 2 that I'm adding.
You added
to add 5. Yes. Okay. So as someone that helps people write last will and testaments, which I do, I'm going to say that 1/3 number seems a little high to me. What do you think?
Yeah, I agree. That the number sounds actually really high to me. I would guess it's probably more along the lines of 5 to 10%.
I agree.
Yeah, for all Americans have a financial plan, and maybe 15 to 20% for folks that have done a good job of accumulation or maybe looking to retire. So, Michelle, first, let's tackle the reasons why people don't, starting with they thinking they don't have enough money. Now, I'm going to tell y'all, I've been doing this for a number of years. There is literally no magic number to, quote unquote, having enough money to need a financial plan. And what one person will view as a huge pile of money that will never run out, another person will view it as not nearly enough to be taken seriously by people in my industry. Neither side of that usually is right. It's all dependent on the particular situation. I can also tell you from experience that most people a lot of times don't have as much money saved as you think. They've got a big house, they got a fancy car. Sometimes that's misleading. As Michelle likes to say, stop comparing your insides to someone else's outsides.
Right on.
Right. So that's the one on not enough money. If you have anything, if you have something to lose, if you have people that are, really count on you to make this money last, then you're a good candidate for a financial
breeders.
plan. Right. Also, now to answer the question on time and complexity, we use, here we go again, talking about the software tools that we have. We have tools like eMoney, Retire Up, Holistaplan. We have all these tools, particularly with eMoney and Retire Up, that make it relatively easy to gather and sort the data that we need to go into an ongoing dynamic financial plan. It's not that hard anymore. It used to be a lot of, what's that thing we would use in math where you had to look?
Abacus?
Yes, it used to be a lot of abacus type of work. Those days are done. And plus the plan is easy to update. You can stitch in a lot of your other accounts into it. So it's an ongoing living, breathing plan. It takes a fraction of the time that it used to. So if y'all are interested in starting that conversation about a comprehensive financial plan, it doesn't matter how much money you have. It's not going to be that complex, and it's not going to take some of your time. Give us a call. It's one of the main things we do at Gulf Coast Financial Advisors. Call us at 251-327-2124. I like that.
Yeah. Also, this article, another thing I want to point out is that it did say that when it talked to people, whatever category they might have been in, when they started making a financial plan and had one, how big or small that might be, it did boost confidence in them no matter whatever tax bracket they were in. They felt more confident.
Well, we're going to talk about that peace of mind that comes with having a financial plan to go along with your investments. So that's great. Great point.
All right, very well. So for our next headline, I decided to go with something that sounded aggressive.
Okay. I'm scared.
Yes. Although it does introduce couch potato investing, which was my takeaway because that sounds like my style. Okay.
All right.
But I think it speaks to some of the reasons that people are nervous about using or even meeting with a financial advisor. I pulled this from Money Genius, and it's titled Trusting Your Financial Advisor. -11 signs they may be ripping you off. Okay, so firstly, obviously, the title is way long. Okay, I'm exhausted reading it. And the article is actually pretty long, too, to go with said title. Yeah, exactly. So, and I know this subject is near and dear to you, so I'm just going to let you riff for a minute about what your thoughts on this long-winded article.
All right, well, so, 11 things. First, I think the article is actually written in Canada. Is that right?
It is actually Canadian couch potato investing. Okay. Quarter Canadian, eh?
Yeah, Michelle's quarter Canadian. There you go. So,
passive and low key.
There you go.
Like that.
Yeah, right. So some of the terms that they use in the article are going to be a little different than what we use in the U.S., but the same basic principles will apply. There's pretty good meat on the bone in this article, Michelle, and as you just teed up, a lot of it actually irritates me just as it would a common investor. As I tell folks that get to know me pretty well, and particularly clients that come on to our practice, I got into this business actually in my mid-30s. I did not do this right, even though I went to college for this. I didn't circle back into it until I was in my mid-30s, and I was already a full-grown man then. So I came into all this with a pretty healthy dose of skepticism for some of the promises and some of the nonsense I would hear from our industry. And so some of the things in the article that both make a good point and also get in my own personal crawl would be when your financial advisor doesn't explain how they get paid. That's a huge red flag. They should be upfront with that. This one, your financial advisor boasts how he or she can easily beat the market. Oh my God,
liars.
Run for the hills. I mean, that's a very, very unique trait that very, very few people have. Warren Buffett and some hedge fund managers, but not your everyday regular Joe Blow is going to have that trait or that skill. And I've seen this like a lot of times, and no offense to my insurance-based brethren, but a lot of times in that industry, when you do talk to your financial advisor, they're kind of under pressure to sell you something because they're typically commission-based, and they've got it's called eat what you kill, which is not so great for the client sometimes. And then the other thing they had on there, and I didn't pick out all 11 because that would be our whole show, but your financial planner hasn't offered you a financial plan. Well, anybody who listens to the show regularly or checks our website or talks to us knows that discussing having a financial plan is one of the first things we're going to discuss. If you want to have that conversation, again, give us a call, 251-327-2124. Very good, Canada. Yes. What's next? What we got in the U.S.?
Okay, back to the United States. So, our third step in our opening segment, the one regarding getting an analysis of your investment portfolio. I hesitated including this article and commenting on it because it's probably going to sound like I'm picking on the author some, but she actually sounds very intelligent. Okay. The article is from Morningstar.com, not the veggie burgers.
Right.
And it's titled "A Year in Portfolio Review in 7 Easy Steps." I don't know how easy they are, but there are 7, so she gets accolades for that as well. So I only counted 2, maybe 3 that are actually what I would call, quote, easy, unquote, in this list. Assess your asset allocation. All right, I kind of get it. I follow that. Check the adequacy of your liquid reserves. That makes me seem I need to stock my bar. That's what that sounds like to me, which is also a fact. Okay. And then there's this doozy. Assess sub-allocations and troubleshoot other portfolio level risk factors. Whew. So I kind of blanked out after that. So what does she mean, and how in the world would you be considered easy if it is?
I mean, I'm in this nerdy thing every single day, and even that's a mouthful right there. So and here's the thing. I think it's fair to say that my industry does sometimes like to use big and obtuse terms. Maybe even to make ourselves maybe sound a little smarter than we are.
Yes, that's a common thing.
But to be fair, because there'll be a link to this article on our website when we transcribe the show, I do not think that this author is doing it with the article. She seemed pretty sincere and pretty intelligent, to be fair. And she makes a couple of points that I think most folks would understand, such as conduct a wellness check, assess your asset allocation, look at inflation protection. Inflation protection is something we talk a lot about on this show, right? Making sure you've got part of your portfolio dedicated.
Which is important because it keeps on going up.
That 100%. It did cool off a little bit here lately, but it's still going up, right? But, checking the adequacy of your liquid reserves.
Hard to say.
Sub-allocations. I'm not even sure I knew what a sub-allocation was until I'd been in the business for a couple of years. These are things that I think, if anything, point to the need to have a qualified financial professional help you guide through some of these things, because they're important steps, but they can be a little bit complicated. So, some of this kind of what I just said with sub-allocations will be something that a program like Riskalyze would be a great fit for. So, of course, selfishly, these are things that we all do at Gulf Coast Financial Advisors. We are kind of math and numbers nerds, but in a good way. So give us a call, 251-327.
I prefer words.
2124. Yeah, I prefer math and numbers. All right, very good. We got time for one more?
We do, but it's hump day and I'm exhausted, so I'm just going to do one more headline.
Okay.
So I'm going to go deep this time, though. We usually reference news sites that the general public would visit, or at the very least, serious investors would read, such as Barron's, which I now get in my inbox every day. Okay, but this time I'm going to a site that I believe is probably read more by financial advisors like yourself versus everyday savers like me. And I'm talking about Michael Kitcey. Kitcey's. It's Kitcey's. Okay, site. Nerd's Eye View.
Right.
And let me tell you, he is a nerd.
He is.
Because I read up on this guy. Whew, Lord.
That is one busy dude.
And he was creating software on the side, like in
Yes.
his, okay, enough already. Okay. Anyway, he has a blog he wrote called Systematizing Reviews of Client Tax Returns by Building Software to Automate Them. And boy, did he do it. So I know this blog is mostly about tax planning software, Holistiplan. So, Josh, why don't you explain who this nerd is and what he has to say about Holistiplan. What do you have to say about how Holistiplan is useful to our listeners?
So, Michael Kitcey, if you're listening to this, you've been a huge inspiration, and we mean it as no offense, but you are. Yeah, I mean, he
it sounds like the football players.
Well, he leans
brothers.
He leans into it a little bit too, to be fair. So, for those of y'all, the average investor is not going to have heard of this guy Kitcey, but here's the easiest way to sum it up because his bio is huge. If there was ever a need for like a CNN or a Fox News or MSNBC or anybody like that to bring on, quote unquote, the expert in what financial advisors and planners do and what they're thinking, Kitcey would be the guy. He's as plugged in as anyone in our industry. He started a ton of great platforms for advisors like myself, and he really was a first mover with his blog and his podcast. Now, to be fair, I think Kitcey is affiliated with Holistiplan, but he's got such a reputation as a straight shooter that I don't really think it matters with what they're trying to promote on here. In a nutshell, and again, I want to remind everybody, I'm not a CPA or an accountant by training, but I am a financial advisor, and I do dive into a lot of this stuff. We do use Holistiplan. We do some basic tax planning. But basically what the Holistiplan is going to do, it's going to start with a tax return. There's going to be a set of algorithms that are going to be run on it. It's going to spit out a report that, hey, here are some of the key figures on the return. And it's not going to be, it doesn't really spit out recommendations right off the bat. It's more observations, but it's things that you can take action on. And then the other cool thing is what it does is it will build in, it's got a projection tool. So not only can you make observations on the tax returns that are already filed, you can also start running some numbers for the next year. For example, do we want to take that capital gain or not? Do we want to do a Roth conversion or not? And what's going to happen to my self-employment income if I move block A to block B, so on and so forth, right? So really at the moment, the idea is it helps guys like me, financial advisors like me, men and women, to do end-to-end tax planning, forward-looking tax planning. And it really, and its cool thing is it provides a really nice and easy to understand deliverable to clients. It's a great tool that we use that I'm excited to use more and more, particularly because I do partner up, as you know, Michelle, I partner with a fellow advisor named Will Stye.
Yes.
Will is a CPA by training. He does not do tax returns, but he is also really good at using his accounting background and the Holistiplan software to take it to someone's unique tax situation. So anyway, for those of y'all that want to keep a little bit more of your hard-earned dollars in your pocket, of course, up to the legal limit, why don't you give us a call? We can run that analysis for free, and we can start a conversation. 251-327-2124. All right, is that it, Michelle? Is that the end of the headlines?
That's a wrap.
All right, very good. Well, great job as always. These are all, in my opinion, important pieces of information that's going to, or already is, going to impact those of you in or near retirement. And again, listeners, if you have questions around the headlines and the topics that we discussed, and particularly, as you can see, a lot of this is related to your investment strategies and your financial plan, just give us a call. It's 251-327-2124. It's just going to be a conversation. There's no obligation. There's no fees associated with it. Or if you prefer to reach out via email, just find our contact page on our website, gulfcoastfa.com. That's GULFCOAST, FA as in financialadvisor.com. All right, folks, coming after the break, we get to have a little fun, and we have fun anyway, but we get to have a little more fun, and I'll probably get picked on a little bit by my co-host, Michelle. Mm-hmm. In our next segment, we call it Where Josh Nailed It, where Josh was a little off. And so here's the thing. As someone that has always had strong opinions and often sometimes public opinions. I think it's important to hold myself accountable for the things I've said that didn't quite stick the landing. But to be fair, we also get to discuss where my often skeptical viewpoints proved to be pretty accurate. Hello, Bitcoin, crypto, thank you. Right? So remember, everybody, I'm originally from the Show Me state of Missouri. So what's that mean, Michelle?
That you have to show them and not just talk about it.
Don't tell me, show me. Stay tuned.
Hi, Michelle here. If you're looking to inflation-proof your retirement and are ready to take that next step, but don't want to wait for one of those upcoming seminars, just give the advisors at Gulf Coast Financial Advisors a call today and schedule your no-obligation in-person review with Josh and his team. Maybe it's time for that second opinion. Make sure to call 251-333-5151 or visit us on the web at gulfcoastfa.com. That's GULFCOASTFA as in financialadvisors.com.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. PCIA 6201 College Boulevard, Suite 150, Overland Park, Kansas 66211. PCIA doing business as Prime Capital Wealth Management and Qualified Plan Advisors. PCIA and Gulf Coast Financial Advisors are not affiliated.
All right, welcome back. Your host, Josh Null, here alongside my lovely co-host, Michelle.
Hello.
Yeah, so if you know me in real life, then you know that I tend to have strong opinions. And as someone that has had a radio show in the past, before this one, predecessor, and a couple of podcasts over the years, I've often espoused those opinions publicly. Sometimes,
good word usage. I like that.
I like it, yeah.
Yep.
Sometimes I've been proven right with time, and sometimes let's just
skunked it up.
Yeah, just didn't quite stick the landing. So each week, Michelle and I, we get to do this segment, and we use it as a way to poke a little fun at myself, at the thoughts and opinions that I put out there that maybe weren't 100% on point. But to be fair, again, I can be a little skeptical. Sometimes I'm right. I've been right. So I'm also able to point out some of those thoughts and opinions to our listeners, and plus the lessons that we learned from both. We call this segment Where Josh Nailed It, where Josh was a little off. All right, Michelle, what you got? What's first?
Okay, so a little blast from the past. In one of our previous episodes, you and I talked about how bond laddering had become a valid way to generate income in retirement, now that rates had risen to competitive levels after so many years of low interest rates. You also stated that the recent bank collapse of Silicon Valley Bank could have possibly been avoided if the bank's executives had simply laddered their bond holdings instead of just putting so much money into long-term bonds. Did you nail that, or were you a little off? I know the answer.
Oh, you do? Okay. All right. So to be fair, this is an overly simplistic way to look at it, but in general terms, yes, I nailed it. Right. There's no guarantee that SVB, the bank we're referring to, or particularly Silicon Valley Bank, would have made it if they had laddered their bonds, because what is emerging is a lot of other poor decisions coming, and that might be some PR for all we know. I mean, there may be a lot of banks making that decision, but the one thing that they definitely did that is what got them in trouble, and we talked about this on a previous episode, is they went long on 80 plus billion of their securities, their debt instruments. In fact, I think it was mostly mortgage securities.
It was.
Right. And what happens in simplistic terms is when you buy the debt instrument that long, you're buying it at a certain interest rate. When the interest rates rise, which they did very rapidly, now the price, the competitive price to sell that bond drops. Well, here's the thing: if you're not under pressure to sell that bond, then you just hang on to it till maturity. You collect your interest and you move on down the road. It kind of, it kind of sucks. You maybe you collect 2% when you could have got 4%, but no harm, no foul, generally speaking, right? What happened here is there was a spook, some type of spook on the bank, and people started withdrawing money. Well, anybody who knows anything about banks knows that banks don't hold all their money in cash. We've all seen the old shows where they open up the vault and there's
got the gold bars.
Yeah, there's a bunch of gold bars. That's not how it works. And so what happened with SVB in particular is they started having to sell these long-term debt instrument securities at a significant loss. And so it just spiraled quickly. Right?
Yes.
Now, what have they done? And why they didn't do this, I don't know. I'm sure there had to be at least some type of pretty smart folks running the joint. But instead of looking at all of the money that was getting pumped into the economy by our U.S. government and saying, hey, inflation may be on the horizon, and what comes along with inflation? higher interest rates. Maybe we ought to structure this a little bit like our retirees do, and we'll have our debt instruments maturing at different time periods, and we're going to shorten up the maturity time period. That way we don't get stuck with $80 billion of decreasing value bond security. So, but they didn't, and that's what happens.
Sure did.
So on this one, definitely nailed it. Now, I'm sure more information will emerge because it was the second largest bank failure of all time, right? So there's going to be, if nothing else, some PR work there on who to blame. But really, what it came down to was simple math. Got them in the end. So nailed it.
Yeah, and math's really not hard.
No, it's not in this one. It's actually one of the more simple things in our industry to understand.
I still am amazed the bank couldn't even sell itself. It's okay, whatever. Okay, so in one of your seminars late last year, you discussed sequence of return risk and how you were concerned that those retiring in 2023 were facing a similar situation to those folks who retired in 2008.
What a gloomy guy I was back then.
Yes, dumb doomsday.
Right.
The main point I think you were trying to make in all that is that all the indications pointed to a significant stock market decline in 2023, possibly even a bear market. While maybe not as severe as 2008, hope not, a significant market dip right out of the bat could set investors' portfolios back years. As you said many times before, you're not a soothsayer. We haven't finished our mind reading classes yet, and we don't have a crystal ball. But do you feel that you nailed it, or are you a little off with this opinion?
Well, okay, so to be fair, we pointed this also out back in one of our February episodes of Coastal Retirement. And here we are again in April of 2023. And yet again, when you look at the index, the average indexes across the board, you'd have to say I was a little off so far, right? The Dow's up, I think, over 1%. The S&P, I think, is up actually around 7%. The NASDAQ 100, even with all of the tech beatings that's been going on with Tesla and whatnot, the NASDAQ is up in general. And the funny thing is, Michelle, I'm dancing around the fact that I've been a little off, but I'm usually the glass half full guy.
Annoyingly so.
Right. Fair. Thank you. All right. I'd rather be that than not. But so here's the thing. What Michelle's referring to is sequence of return risk. And again, this comes back to simple math. I'm not going to bore you with all the nitty-gritty details, but I'll just give you kind of a rough example. If you had two brothers retire with $1 million, and one retired at the beginning of a prolonged bear market, that means the market's down, and one retired when the market was steady or possibly even rising, what's called a bull market, what is so vitally important to your overall longevity or portfolio is those rates of returns early in your retirement. If you've got a pretty banged up down market, especially like 2008, if you look at the projections, you can have, even though you both started with $1 million, the man or woman that started retirement in a very down market or even just a bear market is going to run out of money years ahead of the other person.
I remember the graph.
Yeah, sometimes 10 to 15 years earlier. And so it's really so important that you don't want to be pessimistic. Maybe I was having a bad day back there in November, December, but you definitely want to account for sequence of return risk. It's something that we are going to look at because I will say common sense will tell us that you and I may be having an episode here in a couple months, and I may be saying I nailed it on some of the market getting beat up. But sequence of return risk, if you want to learn more, give us a call, 251-327-2124. We're happy to have that conversation with you, especially those of you all looking at retiring this year. So
yeah, and the graph is pretty telling that you have when you go along with it.
It's math. I mean, it's not
exactly.
Yeah. So, all right, what you got next?
Okay, so you've openly and often encouraged retirees to delay taking Social Security until their full retirement age because the benefit increases by 8% annually. But recently, there's been stories about Social Security running out of money by 2034, which I also tend to believe. Okay.
Yeah, I thought of you the first time I saw the first.
Of course, I think it's going into a black hole, and I'll never see it. But it sure does come out of my paychecks. But anyway, so instead of waiting, shouldn't people grab all their money they can before this thing goes belly up? Did you nail it, or were you a little off?
All right. So as far as my opinion on if you can, if you've got a plan, it comes back to financial planning, and it makes sense, and you can delay Social Security, then in general, I'm gonna say, hey, I'm nailing that opinion. More often than not, if you will hang tight, you're going to have a much higher benefit. It's the only thing, we've said this in the past, Michelle, and you always got to be really careful because this can be misconstrued, but it's really about the only thing out there where you can squint at it sideways and say that it gives you an 8% return year over year, at least up until your full retirement age or particularly age 70. Now, you can't guarantee that, but that's basically how the whole structure is set up. There's no other investment on earth that can look at that for income increases, especially backed by the full faith of the United States government, and which allows me to pivot to why I still think I've nailed this. Yeah, mathematically, Social Security is going to run out of money at 2034, latest projections, right? I'm gonna take off my financial advisor math nerd hat. I'm gonna put on my United States citizen hat, and I'll ask you, Michelle, is there any politician that's going to let Social Security lapse?
There may be.
I don't know. Here's my thing.
Listen,
Right, so
I was watching some hearings today, so it's questionable.
Well, here's what most people don't realize. Social Security is literally the most successful program in the history of mankind
for now,
at dramatically reducing elderly poverty. I'm going to repeat that. Social Security is the most, in world history, nothing has been as successful at reducing elderly poverty. When they instituted Social Security, almost over a third of the elderly United States over age 65 were in poverty. And now it's less than 10%. Now, not to make light of the ones that are still in poverty, please don't take no disrespect, but I'm saying it's been a drastically successful program. The two things I think you will see, one is I think there's a possibility of means testing. If you retire and you've got 2 million, 3 million, 5 million, whatever the number is, whatever chart they look at, they're going to say, hey, we're not going to not give you Social Security, but we're not going to give you the same amount that we're going to give someone that does not have your type of retirement. And two, I think as we see this generational boom of more young people, which is young people with what saves the world, you're probably going to see a little bit more aggravation or more complaining. The fact that, hey, because Social Security basically, Michelle, is taking money from young people and giving it to old people.
Yeah, it is. It's happening.
That's what it is, right?
Yeah.
Right. So
I've been working for a long time.
As this political class of baby boomers and Gen Xers start to age out and you got more young people coming in, there may be some pushback on that. But in my opinion, no. If you can hang tight and delay your Social Security, coupled with a comprehensive financial plan so you understand what's going on and you're not just adding stress to your life, I think you should. I think I nailed it. And I think if anybody wants to have that conversation, particularly about some of the things we can do to look at optimizing that choice, again, give us a call, 251-327-2124. Very good. Michelle and I don't totally agree, but that's
no,
the point
we
of having
don't.
the
And we've
show.
talked about the Social Security before because it's sus to me, very suspect.
All right. Well,
but even though the payments did go up this year,
when we're on
that was one of our earlier episodes. I think Tiddlywinks, $108 or something.
No, remember it went up over 8%.
Oh, is that what it was?
Right. Yes.
So I think it ironed out to $108.
Right, so
there was some kind of number like that.
So when we're on our 20th year of coasting retirement, then we'll both be able to tell you all if we nailed it for good or not.
Or if we're getting Social Security.
All right. What do you got next?
Okay. All right. You have stated that because at various points in your career, you have once hosted a weekly 30-minute radio show and additionally 2 podcasts that start...
I feel like Ron Burgundy, like I'm kind of a big deal around here, but I'm not.
And mentioned that starting a weekly 1-hour radio show on a major local FM station would be no big deal.
Caps.
Yeah. Period. Space. Pause.
Right.
So... and I've got some opinions about this too, but since I'm on board with this one, I can't compare it to your previous stints, but did you nail it or were you a little off?
Well, okay, so first, to be flattering, on my choice of co-host for our new show, Coasting in Retirement, I nailed it big time, right?
Obviously.
Out of the park, right? Yeah.
Totes.
Michelle Melton, thank you. Michelle Lee Melton, thank you very much. But honestly, with the rest of the show being no big deal because of my past experience, I was way off. Our show...
It is time consuming.
Yeah, Coasting in Retirement is a completely different situation from my prior efforts. Listeners, you should know that we kind of make a joke of this, but the links, the great links and the energy that Michelle and I go to prep and record this show.
Yeah, this is in addition to our day jobs,
right,
which we have a couple of those too, because we have side hustles and whatnot.
That's right. Yeah, it's like working in a coal mine almost.
And we're social creatures.
That's right. So let me explain. The first radio show I had was called Focus on the 5. Baldwin County is county number 5 in Alabama. It was about focusing on business owners here in Baldwin County, human interest piece, if you will, on WABF 1480. And on that show, Michelle, all I had to do was ask questions.
Right.
The people I had on were great.
Yeah, and they wanted to talk about things.
I was there to promote their business, right? And it really helped me get to know people in the community. It was how I kind of started my business down here. I'm so glad I did it. And then the podcasts that I would do in the past, Every Dollar Counts and Wealth and Waves, those were recorded in batches, and the episode time was usually 10 to 15 minutes, maybe 20 minutes at most. So, and then plus here, what we do at Coaster in Retirement, listeners, regular listeners know that we have some evergreen topics, but we really have set it up to be a timely show. I mean, Michelle, with
Yeah.
the news of the week, that's a timely segment. So every week we've got to dive in and do these things. So I came in probably a little cocky on, handle this. But I'm so glad that we decided to do it. And I think it's worthwhile. And I think we put out a good show. So I'm happy.
Well, I hope everybody agrees.
I agree. Yeah.
Keep listening.
That's right. All right. Very
Okay.
good. Yeah. A little off.
Just a little.
Got one more?
I do.
All right.
All right. You said often that most investors with a written financial plan, which we talked about earlier, tend to weather stock market volatility a little more calmly than those with just an investment portfolio or stock account or stock accounts. You've also said that the type of account an investor has often depends on the type of advisor they've chosen to help them. Did you nail it with these two related opinions, or were you way off?
All right. So first, let's talk about so number one, nailed it. This is a big softball down the middle for me. Let's talk about when you have a
You're welcome.
Right. When you have a financial plan, what that does, among many things, and Michelle, you mentioned it earlier, there's a calming effect. It gives you some confidence,
Yes.
right? You have your handle around it about your,
Well, part of it's not knowing, and once you know, it's half the battle. Isn't that what G.I. Joe said or something?
Well, yeah. Plus it helps take the emotion out of your money, right? And additionally, what it does, it will help put your investment portfolio in its proper perspective, particularly for those of you all that have a long-term horizon. Now, this is going to surprise some of you pre-retirees and retirees when I say most of you have a long-term horizon. Here's what I mean. You're going to have part of your portfolio, your investment portfolio, that should be geared towards the long term. That's the only way that you're going to be effectively fighting the inflation battle, the interest rate battle, things of that nature. And remember, for those of you all that are retiring in your 60s, early 60s, mid 60s, even early 70s or later, people are living longer and longer and longer than ever before.
Indeed.
Right? And so let's say you even have to wait till you're in your 70s, or you want to wait until you're in 70s. There's at least a decent chance you're going to have 20 years of retirement. And if you look at the stock market over any particular 20-year time period, again, as long as you believe in the future United States, obviously, but over any 20-year time period, it tends to go up over time, right? But what happens is painful in the short run. And what can help you in the short run is when you see these dips, and the dips are going to have, they just come. What has kind of skewed it a little bit over the last couple of years, particularly since COVID, is the dips, the ups and the downs. What Michelle referred to earlier, the stock market volatility has been historic. The difference between the lows and the highs has been greater than ever in the history of the market. It's nuts, right?
And the predictions were way off for the last, 10 or 20 years.
Right. So when you've got a financial plan and you've got the right type of advisor, we talked about earlier in the show, I am a fee-for-service, fee-based financial advisor. There are duly registered advisors out there. There's brokers. There's insurance agents. The different kind of advisor, as long as you got the one that fits you the best, I would argue fee-based and fee-only is the way to go, but that's obviously, I'm going to be a little biased there. But if you've got that coupled with a comprehensive financial plan and you've got your money doing the work that it's supposed to be doing in there, including maybe getting ahead of some of your worries of the market going down and moving that money into something that's a little bit more capital preservation based, then you're going to have a greater calmness and a greater something where you don't have to look at this stuff every single day because you've got a plan in place. You've got a roadmap and you're staying on course, right? That sound good, Michelle?
Indeed, it does.
It does. All right. And of course, we do comprehensive financial planning at Gulf Coast Financial Advisors. You can call us 251-327-2124 or find us online, gulfcoastfa.com, Gulf Coast, GULF, FAs and financialadvisor.com. All right, Michelle, so we're done with that segment. You have anything else? We got everything?
Nope. That's it.
Good. Once again, listeners, of course, I didn't totally nail it with all my opinions, but I think
it wouldn't be fun if you did.
It would, but I think I had valid reasons sometimes for being a little off.
Sure.
And as with everything, as you get older, you learn to be a little more open-minded. So now to our listeners that have more questions about the things we talked about in this, again, one more time, call us at 251-327-2124 or find us online. You can, gulfcoastfa.com, or it's easier to remember, just Google Gulf Coast Financial Advisors. Typically, we're the first result there. You can also put in Fairhope, Alabama. You put in Baldwin County, we're going to pop up. All right, folks, that's it for us here at Coast Senior Retirement. I want to give a huge thank you to my lovely co-host, Michelle Lee Melton. Thank you to our awesome radio station, FM Talk 106.5. Many thanks to the provider of our show music. That's local band Sloth Racer. That's sloth like the slow animal. Sloth Racer music is not slow. You can find them online. And as always, my sincere appreciation for all of you out there that have been listening and joining us on this journey. And of course, we would love to be a part of your journey as well in our role as financial advisors. But until we talk again next Sunday, have a wonderful and productive week. This has been Coasting in Retirement with Josh Knoll.
Advisory products and services offered by investment advisor representatives through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. PCIA at 6201 College Boulevard, Suite number 150, Overland Park, Kansas, 66211. PCIA doing business as Prime Capital Wealth Management and Qualified Plan Advisors. Certain services may be provided by PCIA affiliates. In this format, Josh Knoll provides general information, not individually targeted personalized advice, and is not liable for the usage of the information provided. Exposure to ideas and financial vehicles should not be considered investment advice or the recommendation to buy or sell any of these financial vehicles. This information should also not be considered tax or legal advice. Past performance is not a guarantee of future results. Investments will fluctuate and when redeemed may be worth more or less than when originally invested.